The second quarter saw the South African equity market retrace quite significantly, with the all-share down 11.7% and the SIX down 10.6%. Even the bond market was negative at minus 3.7% over the quarter. These moves are rather normal when central bankers are raising interest rates and discount rates are moving higher. You'd expect valuation multiples to compress. What is rather unusual is that indiscriminate selling across the board, with most sectors over the quarter negative, except for technology, which had a strong showing at 37%, largely due to Naspers and Prosus during the last few weeks of the quarter. When market participants heard about the share buyback that management announced in their results, there was quite a strong positive reaction in markets. What fails to be considered is that many of these buybacks and attempts to narrow the discount has been ongoing for the last 2 to 3 years with limited, if not negative, consequences. The announcement to the share buyback was received extremely positively. However, the track record of management to deliver value is rather ambiguous. The last 3 years, from the listing of Prosus to about 10 billion of share buybacks that they've embarked on over the last while, has done everything but widen the discount. Against this backdrop, we think an unlimited budget to do share buybacks may, in time, prove foolhardy, as the one valuable asset is sold down to be left with a rump of assets that aren't generating sufficient cash. But only time will tell whether the unlock will actually deliver to shareholders' expectations. With indiscriminate selling across the board, many opportunities have started to emerge in the domestic market. We find opportunities in both the financial sector and selected industrial companies. With the banks trading at single-digit PEs, strong capital bases, and muted earnings growth, we find the return profile very attractive. We think that longer term, there's an opportunity to generate higher returns and that the dividend yields on these businesses should tick up in the next while. Industrial businesses like Bidvest, with strong management teams, good balance sheets, trading at early teen multiples, should provide medium to long-term positive returns. We would still avoid certain sectors like food producers, where commodity prices will squeeze margins in the next while. However, we're starting to look at these in much more detail, as we believe the opportunities to acquire these businesses on low multiples with a rebound in margins should pose positive returns in the next 12 to 24 months. Market participants should think about adding to equity exposure prudently over the next while. Current market valuations on the ALSI at 10 times and the SWIC sub 10 times historic earnings provide a valuable entry opportunity for individuals who want to generate longer term returns. The volatility will persist for the next 6 to 12 months, but in that volatility resides many opportunities to acquire strong businesses, good management teams, and great balance sheets for longer term returns.